All right, welcome everyone. We'll give it a couple minutes as everybody's jumping in here. Just wanted to give quick introduction as you're all jumping into the webinar today. Really excited to have all of you for our fundraising from the investor's perspective discussion today. This will be a virtual interactive workshop. I'll have a presentation I'm going through, but we're going to keep it interactive as well. So definitely use the chat. We'll have some periods to unmic, ask questions, be part of the discussion as well. I'm also going to share a quick poll we'll start off with we'll share responses on the third slide here as well. So let me reshare that. Oh no, that actually worked. Okay. No, it didn't work. Let me share that in a different way so you can all actually be a part of it. Here we go. Perfect. Yeah, just a quick, want to get everyone's thoughts as we'll scroll through and show the answers in a few slides here. But yeah, again, we're going to keep this interactive. Really want to shout out all the communities involved. So this is a Startup Grind Boston webinar. I'm the chapter director for the local Startup Grind group. We have it's an initiative that started probably close to 20 years ago at this point. Out in Silicon Valley, the flagship model was always fireside chat events, just sitting down, having a conversation, and getting to learn from other startup entrepreneurs, investors, advisors, and helping getting takeaways in the community in a place where everybody could learn from each other. And then it expanded into several hundred chapters around the world that all host localized and virtual events. There's going to be a big conference the end of the month I'm actually going out to as well in Silicon Valley. We have the details on our Startup Grind Boston page with a registration there. So yeah, if you have the opportunity, definitely go out and check that out as well. And then you'll get to see local and virtual events on our page as well. We also run the co-organizer for the Boston New Technology chapter. We host different workshops, events, a lot of startup showcase events. We're doing partnering up with Techstar Startup Weekend and hosting a 3-day hackathon the end of May. So everything from idea stage events where you come out, build a startup in a weekend and get the help from mentors and advisors and speakers to startup pitching events and showcases. We have a pitch practice we host, a lot of great resources through the Boston New Tech Network, and prepare for VC. We have an upcoming breakthrough program, which is our accelerator incubator. That's the category we always go in, but we're a little bit different. Our focus on being a breakthrough founder means there's always a roadblock, and we hope to uncover those. We've worked with dozens or hundreds of entrepreneurs through 8 cohorts of the program, and we've seen founders break through with their new storytelling, their fundraising. We've helped founders raise over $450 million in VC financing and really expanding their network, learning from each other, and growing and scaling as an individual as well. And big shout out. So I'll mention the other sponsor first and then turn it over to Nick, who's our big sponsor from WeWork for today. The other sponsor we have is Greenberg Touring, who is part of a lot of our most of our in-person events. So they'll be over at our startup showcases, the Techstar Startup Weekend Hackathon. Great law firm in the Boston area, really hands-on, and we've gotten to work with them as mentors and advisors throughout all the programs that we run as well. And really excited, we brought WeWork on board recently as a great partner. We've shared some special offers for the community in recent newsletters. And Nick is here to join us. He's the vice president of sales at WeWork, leading the East Territory. He has a lot of great experience from LinkedIn and Yahoo, opening new markets, driving growth, and he's an executive coach and startup investor and advisor himself. So perfect fit for working with us on this webinar today, getting to know all of you. And he'll be a great resource for all of your ventures going forward, whether you're looking for new space or just looking for new advice outside of work. He's also loves spending time with his wife and twin boys and attempting to fish. I really like that, with minimal success, or training to be a point guard for the New York Knicks. If we switch that to Celtics, we'll be in good shape, but best of luck either way. So Nick, I'll hand it over to you for a quick introduction as well.
All right, perfect. Thanks, Jason. I figured that would come up, and the Celtics have had success. I don't think you need any more depth on your team. So hopefully my Knicks can do something this year. But great to meet everybody. Hey everyone, as Jason mentioned, my name is Nick DeMarinis, Vice President, Head of Sales at WeWork. Where what do we do at WeWork? We help companies of all sizes, from entrepreneurs just like yourself to some of the largest enterprise companies in the world, find workspace that helps them innovate and grow. So, in addition to that, as Jason mentioned, I'm also a startup advisor and mentor. I work with a lot of early stage companies to take their business to the next level, and that's a lot of what we're here to learn about today. So today's session it's really all about flipping the script. We're going to step into the shoes of the investor and understand how they actually evaluate early stage startups, and that's why we're excited to partner with Boston New Technology and Startup Grind Boston, and to have Jason himself, incredibly insightful, to share a lot on these topics today. And what we see here at WeWork, in terms of entrepreneurs, but also from Jason's session today, not just talking the talk, but walking the walk. And as a serial entrepreneur, investor, founder, prepare for VC, Jason's seen thousands of pitches, knows firsthand what makes investors tick, and more importantly, what makes them invest. So, what I'm excited about is over the next hour, Jason's going to walk us all through how investors are thinking about fundraising and share very tactical strategies that actually work. And again, myself, as someone that is involved with early stage startups, as well as being part of companies that I've scaled like LinkedIn and WeWork, I know firsthand what it means to have the right team members, and that being a critical to success. So we're going to learn a lot more today about how to startups and yourself can find the right investors for your company. And with that, let's get right into it. I'm thrilled to kick it back over to Jason Kraus. Thank you.
Perfect, thank you, and excited. Excited to have you here sharing. I'll tap into you to share some additional knowledge, expertise as well. If you want to share any links or any other info, also encouraged everybody to share their LinkedIn and connect with each other in the chat as well, and just shared mine as well. So yeah, let's keep this interactive. Also want everybody to get to know each other here that joined our webinar today. This is what we'll cover. We're going to start off with a quick icebreaker. Again, for the link for that is, I'm going to put in the chat in case you recently joined as well. Just take a quick second, fill out that poll. And yeah, then we're going to go into how investors actually think, the 3 pillars of investability, fundraising, mistakes, and how you fix them. We're going to talk about what makes a pitch stick and go over an example of a successful pitch and hear what stands out to you. And then we're going to dive into more AMA, ask me anything and final takeaways, but also any questions you have throughout. Happy to address and dive into those as well. So let's see what. Let me try to refresh this because I did see responses coming in. All right, I'll just go. I'll present this for a second. So what's your biggest fundraising challenge right now? We have some people not knowing how much or not sure how much to raise right now, don't know where to start, hearing it's too early or come back later is definitely a big challenge for a lot of folks on the call as well. So we'll address all of these and help you figure out where to start, where to go, how to raise, how much, all as part of today's discussion. And addressing the it's too early is definitely a key piece. So this is the investor's perspective of. I always think it's really important to think through investor mindset anytime you're coming in as a founder and trying to pitch to investors. So what a deal looks like is it's not always let's say you get let's start from the negative. Like let's say you get a no from investors. It doesn't necessarily mean they're not interested in your startup or they don't think your business is going to be successful. It means if we're going to invest in the investor has they probably raised a fund, on average, they might be investing in 20 companies, or maybe they have a bigger portfolio number, but let's say they're investing in 20 companies and out of those they're going to do follow-on investment. It just means they haven't selected you as one of those 20, and there's a various reasons. They have something they've gotten all of their investors on board for and said, this is our thesis, this is the stage, the type of company, all the requirements we're looking for, and we're going to stick with it. And that's how they got people to invest into their fund. If it's an individual investor, they might have a little bit more leeway, but they're still, making decisions based on how much they can realistically invest into a certain number of startups over a certain period of time. And so this is a breakdown of an investor pipeline. Is you might start with 1,000 to 5,000 deals in a given year. That's everything from pitch events, referrals, applications coming in directly to you, working with other referral sources like incubators, accelerators, and even doing outbound prospecting or having venture scouts or analysts go out and look for more deals and bring them into your firm as well. A portion of those you bring into initial screening. So let's say that might be, that could be 10 to 20, 10 to 20% of those companies have a preliminary review of the pitch deck, executive summary, initial outreach, email, narrow down the best fit prospects. The more now there's more tools and resources that help with that initial screening. So there's everybody has a slightly different process. Everything from some are investor. There's a DocSend did a report. They have a pitch deck sharing application where you can see the time everybody spent and reviewed your deck, and on average over several years, most investors had spent 3 minutes on the deck deciding whether or not they're going to move forward with a call. And so there's screening mechanisms from spending 3 minutes per deck on a lot of applications to having other filtering mechanisms now with AI tool sets and other screening tools, and application platforms to narrow down and have more conversations, but with a smaller pool of people. Everybody has a different methodology, and that's where there are so many different venture funds. Is there's a pitch to their investors where they say, hey, this is our thesis, this is how we're going to get deals better than everybody else out there. And it's similar to raising as a startup. So they've done this. They pitched to their LPs, raised a fund, sourced 1,000 to 5,000 companies, gone through a screening process that's unique to their firm. Then they take first meetings with a portion of those, could be 200 to 1,000 companies in a year. And then some out of those, they deep dive into what's called the due diligence phase. So that means they're going they're really digging into the business model, financials, market analysis, customer validation. That's when they're doing their own research. They're also looking at any additional documents you put together, like your financial projections and plan. Going into talking to other customers, either potential potentials in their network or that you might have recommended and introduced, and checking any references. So that's where they can't deep dive into every single company if they've taken a first or even a second meeting with, but the companies that enter the due diligence phase are all with the intent of either making an investment or figuring out what red flags there are that would prevent them from making an investment. And then they end up investing in most, I'd say, are at the 5 to 10 a year in the investment phase, and you might have 3 to 4 years of an investment phase before you raise raise another fund. So each fund itself could invest in about anywhere from 20 plus companies, depending on their structure. There are some that have 100 company portfolios and have more of a volume strategy, but most common, I'd say, is around like 25, 20, 25 or so portfolios, and then you raise a second fund or a third fund and keep building out with new ventures. So this model is to show you, the process of the investor and then what they look for. So first off, you're narrowing down you are looking at what companies are most exciting, and you have to believe in the vision. But any company out there that's really exciting as an investor, especially pre-seed and seed stage, the mindset is always there's probably, whether or not it's publicly known now, there's going to be somebody else that's going to be competing with you in the future. So the idea is the team is always the most important piece and component, especially at the beginning. Later on, it's super important as well, but you can back up with more traction and validation and show people, your trajectory of growing the company. At the early stages, you're convincing investors, if this was their idea, they would be hiring you and picking you as a CEO. They'd be hiring the rest of your team to grow and scale and run the business. And you're an expert in your industry or sector. You've gone to the right people to learn, and you either or you're the leader of your business. You're somebody they'd want as their leading any company that they were a part of. And consistency is what matters. So basically, a lot of the personal traits, especially like being one of the things investors love the most, and I always love getting updates, is especially post investment. Anytime we love seeing update reports, whether it's monthly or quarterly reports, and additional messages from founders on what's working and what's not working. And that way, nothing is a surprise. Obviously, things happen along the way, but the more you share everything, especially the things that aren't working, the more your investors can also come in with that advisory capacity and say, hey, have you tried this approach? What if I connect you with this individual that could help you out? Or would this company be a great partner for you? And make those recommendations. The worst case scenario is always finding out, hearing everything is like golden, everything is perfect, and then finding out the company ends up failing or not doing well, and it's a complete shock. If along the way, at least there's still a strong relationship built with the founder. Things happen in the startup world. Most companies do fail, and a lot of companies, the ones that have the most success are the ones that are opening up earlier on and sharing both the wins the losses and, asking for that help and connection. So coachability is definitely a key factor. And in the limited time, because again, part of the process, you're going to have limited, um, there'll be shorter windows where you can actually build these connections. And then, an investor is trying to make the judgment call on if you're going to be somebody that is keeping them updated and sharing and being consistent, and somebody that is a great leader of their team in a relatively short period of time. So, it's always looking, everybody has their own methods, but it's looking for some of those traits and characteristics of how you approach a conversation, what questions you're asking the investor as well, even your outreach email and approach of, you know, um, basically what you're sharing is the most important aspects of your business, and anything you can do to make it more of a relationship as well. Like the same way, if this was a customer conversation, the more, let's say, you have a B2B business and this is a customer conversation, the more you can show you've done your research on them, and you've checked out their social media and their website, and really make it a personalized story to why they'd be a great fit and a great asset to use your platform as a customer. The same thing holds true to an investor, getting to know their portfolio, their background, their experience, why you value their judgment and their expertise as being an investor and a partner in your company. The easier that process and conversation and more comfortable everybody's going to be all around. So what's inside the investor's mindset? There's the reason why, that framework, or the what came up in the initial poll here, hearing it's too early, come back later, is it's basically a risk mitigation strategy. It can be really frustrating, but the risk is, several fold. One side is fundraising risk, so it could be, um, I don't believe you're going to raise the rest of the round or have enough capital to make this successful yet, but I want to see how well you do, and then let's have another conversation. It could be attraction risk mitigation, like let's see, it sounds super exciting, but let's see how your customers react, and let's hear more of that story before I put the investment in. Or it could be a risk of they're actually saying no and just don't want to be that person that rejected. It's publicized that they were the one that rejected Airbnb, or they were the one that rejected Uber. And so, I mean, there are things you can do to spot those no's and what they mean. But I think the most important piece is figuring out how to recognize and turn those into a yes. And that can be through update emails, just sharing the traction, getting them excited about everything you've built. Like it's a marker. You've had one meeting with them, you've had two meetings with them, what's happened, or you've, had a meeting with them a month ago, send an update email to all of your prospective investors. And this is everything you've accomplished since that first marker you set out. That's a risk mitigation tactic of they've had that whole snapshot from where you started, where you are now, and they can visualize where you're going to end up. The other strategy is, basically you're going to be able to, you want to prove you're both fundable and inevitable, meaning you're going to do this with or without investment. The more you can show, uh, you're super passionate about this. You are the founder to build this. You have the team, and you're going to make it happen one way or another. The only question for them then is, are they in now, or do they want you to pitch them when you're worth 5 times the amount, you're 5 times the valuation, or come in with a worse deal? And getting that like fear of missing out is something that's really hard to do. But if you can answer why now and why you should invest today versus more of a wait and see model, that's the biggest hurdle you can overcome and get somebody truly ready to go into your business. And then self-awareness and adaptability. The reason I put that in here is we're always looking at those personal factors as well. Do you know, like, and startup, the idea and the reason you're raising funding is to grow quickly. So, do you know what you're already excellent at today and what you need, what some weaknesses are that you need to hand off or bring in another person on when you're hiring, or bring in a whole team of people on to, to adapt and change there? Are you somebody that's able to spot a pivot and say, is really in touch with the customer feedback, and is somebody that's going to be willing to say, hey, we thought we were in the right direction, but we're actually going to be better off if we change our strategy here. And the more you can be self-aware, your team is aware, and you're ready to adapt and make those changes, and what's needed down the road, the more investors are going to be excited to work with you and be a partner with you in this startup journey as well. I'll take a quick pause here, both for questions, and then as we're thinking about everything we've covered so far, also wanted to ask what if there's any, and you can either unmic and share or answer in the chat, if there's any red flags you're currently worried about for your own ventures, and happy to share how an investor would be thinking through any red flags you might be wary of. So if anybody wants to share that, or if anybody has any questions at this point, would love to hear them. Sure. Jacqueline.
Hi, Jason. How are you doing? Just delighted to be at this session, and hi to all the founders here as well. My question is around being a B2C startup. So this might be more relevant here in Europe. So I'm based in Ireland, in case you didn't know from my accent. But we have a B2C startup, and you hear a lot that investors are very wary of B2C because of the perceived high costs that would likely be involved in terms of marketing for it to scale. Just wondering what your thoughts are on that.
Sure. So I mean, one aspect, there are investors in every vertical. Definitely, if it says, if somebody, you can narrow down, or a lot of investors, especially VCs, are going to post their portfolios and their thesis either on their website or Crunchbase and other platforms there. So if they only invest in B2B, it's probably not worth pitching them. But on the consumer side, there's also different regions, and one of the things now that, especially the last 5 years since COVID, people are expanding their investment region. So I'm based in Boston, and there used to be a bunch of angel groups around here that would only invest in companies within a driving distance. And now, they're on Zoom meetings, or they're virtually meeting with companies anywhere. And, they've at least expanded across the US and Canada. Some invest internationally. But, venture VC funds, usually the bigger the fund, the bigger they'll expand that reach as well. So one thing is, like, there's different areas that have specialized, like here, we're great at B2B SaaS, medtech, edtech, and other verticals. California has been great at consumer applications, and that's the biggest boom there. There's other areas that have a lot of investors, either because of their background or just their interest in different verticals. So you could try to pitch people from different locations, but also on the you can use your experience, and basically some of it is finding Yeah. So different locations, and then also checking in on the portfolios and seeing, is there somebody that's invested in a comparable company, but in a different industry that would be a perfect fit based on, like, if they've invested in a consumer tech application and I don't know, the pet industry, but you're doing something similar for humans. Can you pitch to them and try to get them as, into their portfolio using that framework of you're an expert investor in this space because of X, Y, and Z you've already gone into. So yeah, the more you can make it a personal ask, the better.
So good. Yeah. So not really thinking about trying to convince a B2B angel who's mainly B2B here, but maybe think about finding the right investor, even if that's further afield.
Yeah, further away, or just, digging into portfolios and seeing who might even be an unexpected investor that you could reach out to and, share exactly why you want them as an investor as well.
Great. Thank you so much.
Of course. Jerry.
Hi, this is a maybe unusual question. Our company, we have a women's health product, and I've been doing the pitching. And the investors seem to feel that only a woman can understand female physiology. And so therefore we should have a woman doing the pitching. And so we've talked to several female CEOs of medical device companies, and one of them has agreed to help with the pitching. But the latest information I heard was that even if she's female, she wouldn't be credible unless she was part of the team, like a co-founder. So is it even worthwhile trying to find a female spokesperson?
I always like to hear from the team. Like if you're just pitching to be the presenter, it's not as powerful as because the biggest piece that you get out of the pitch should give you enough information that sparks all the questions, and the Q&A part is the most important section there, but the pitch allows somebody to get engaged and excited and have all the right questions to ask you. So that's why I think, the more it can be somebody on your team, the better. I mean, I don't know. I'd never want to advise somebody to have less of a diverse team, but I mean, if you think of experts, like you could, there's male and female physicians and doctors and, gynecologists and everything. So, you could still be the expert for your company if you have somebody else that is part of the business that you want to bring on. Then that's great if they can handle the pitch. But yeah, I wouldn't discredit yourself and everything you've built here either.
Okay. Yeah, one thing we're doing is I have a female co-founder whose major achievement in high school was to get a perfect attendance record. Never went to college, doesn't know anything about business, finance, FDA, patents, nothing. So she is female and she could pitch, but I'm concerned that she might do more damage than good. And that's the question. What do investors think?
I think if you highlight, I mean, there's a reason you picked her as a co-founder that aren't any of those reasons you just shared. So
Yeah,
if there's
idea.
Yeah, I mean, if you're sharing, if it's the highlights of her career and exciting work with you so far, and she's the best spokesperson for that, then great. Like, I mean, there's plenty of great entrepreneurs that all come from different backgrounds. I mean, and personally, our thesis with some of the funds I've been involved in, like EQx Fund, was, first and foremost, the thing that matters is the EQ. So the, ability to understand, even what's on the slide here, self-awareness and adaptability. And it's less about what, I know there are funds that only take from whatever Ivy League schools and stuff, but our me thesis had always been, it's less about what schools you're coming from, or what backgrounds you grow up with, and more your ability to achieve as a founder and an entrepreneur and be an expert in your industry or sector.
Okay, thanks, Jason.
Yeah, of course. You have a good suggestion from Nick in the chat as well about if you can also share more client stories, or have somebody come in as a spokesperson and share a quick testimonial for you as part of a presentation as well.
I mean, it's a medical device, so nobody can use it until the FDA says you can. And we need to raise the money to do this testing the FDA requires before they say you can. So that's a moot point.
Okay. All right. Allison was asking about how much text to put into a pitch that's a send through. So that's a great question, because there's two versions of your deck. One is something somebody is going to read. The other is something you're going to present live. So the more you're presenting live, the more it can be visual and less text. If it's read through, still, you don't want it to be, if we go back to that DocSend statistic, like, you want it to be something somebody can make a decision on, have all the right information, and decide to jump on a call with you within a few minutes of looking at your deck. So that can be a combination of visual and text-based information that answers their initial questions, but also sparks more things they want to understand and jump on a call with you to dive deeper into. And also, yeah, Scott's question around due to the political situation in the US, are certain sectors now considered toxic and too risky for VCs? There's definitely areas that have been more wait and see, or at least have slowed funding a little bit versus other sectors due to new risks. So, that could be with international manufacturing, that could be with even like federal grants and funding drying up in certain sectors that used to be a big, especially in the healthcare space, that used to be a big avenue for non-dilutive funding that added to everything the investor, or like equity investors, love to see there's additional funding that's not taking equity out of the business. So, I mean, that does create additional risk now. It's still relatively early in the process. A lot has happened week to week, so it's tough to say what's going to happen, a few months from now or even a few days from now. But definitely, the more, everybody's keeping up with the news cycles and trying to figure out, what's going to be short-term and long-term effects of all the decisions in the US right now. Cool. And yeah, I'll continue, and then we can dive back into some more questions from there. So one thing on this was designed to help figure out why do investors say no sometimes. So it can be any of the team, the product, or the deal. So the team, what we're looking at is, are they the right leaders? Self-efficacy, that means, like, do you understand your strengths, your weaknesses, where you're going to expand and where you're going to need to bring other people on? Do you have the clarity and vision of what it takes to truly scale this company? And can you execute and prove that, are you somebody that's going to, do you have the right team to execute and turn this vision into a reality? The product, so product market fit. A lot of times it's always focused on the product side, but the market side is very important as well. So that's the demand, the timing. Also, did you build the right thing, but you're pitching to a group that might be less interested than another market. So the more you can figure out the true value proposition, the market it serves, really understand, the growth and how big that is, and is it something that also technology advances? Like, is this something that wasn't even possible a few years ago because the technology wasn't, that's out there and that your team has developed as well, wasn't even possible to build in the past. So there's a reason nobody else, we never like to hear like there's no competitors, but there's a reason, because there's always something, even if it's a phone call or a text message you're competing with, but there's a reason nobody else has built a platform like yours so far. And, the more that's clearly understood and shared and part of your story, the better the alignment is. And then the deal is also another aspect. So anytime you're pitching a deal to an investor, they're going to be comparing you against similar types of deals. So if you're pitching a safe at a 5 million valuation cap on your company, and then somebody else has the same level of, or somebody else has slightly more traction, but they're at 10 million valuation cap, they're going to be compared to other 10 million valuation companies. You're going to be compared to other 5 million companies, and making sure the biggest thing is the risk aligns with the deal and the upside as an investor going forward. So, yeah, you'll be grouped. It's not exactly like if you're a 5 million versus a 6 million, you're in completely different segments. But, if somebody's pitching a 25 million valuation business, they really have to have the level of growth and future growth that compares them with all the other 20 to $30 million companies out there. So yeah, team, product, deal, all must align together. And you want to leverage your strengths in terms of even the order. There's a general framework of pitching to investors with Guy Kawasaki's 10 slides and other tools and resources out there. But you can adjust and change where you put more emphasis or spend even more time, or what you put earlier on. Like if you have an incredible team that, is going to be it's going to be the thing investors are really wowed by, make sure you talk about that and make sure that's highlighted. If your product, if you already have traction with customers, or your product already has a amazing demo that somebody can understand within, a minute, and like you can show a video of it in action and it's super impressive, make that the highlight. These are all things you can leverage your own strengths. And if the deal thing to leverage is if you can paint the story of, we're doing a safe now because VCs are going to want to come into this a year from now when we already have X amount in revenue, and you're going to get a much better deal. You're going to be able to grow in the short term, your return on paper, and then grow in the long term with us. That's how you leverage the deal part of it as well. The prepare for VC 3 pillars to startup success. So these are a framework that we use to break down the structure of our program. So our 10-week breakthrough program, and also internally with our Chart My Course and other tools we use to help founders figure out where they are and where they go next. The 3 pillars are founders and team attributes, execution metrics, and then market timing and analysis. So founder and team is increasing your skill set, your leadership, your clarity, a lot of the aspects we've talked about. Execution metrics is finding those tangible growth metrics. It's not just revenue. There's other factors that can be leading indicators of future growth. So sometimes that's partners, sometimes if you're a medical device, those are all milestone based. So the closer you are to IND submissions or FDA studies, each of those is a bump up in the value of your business, going through different milestones. If you've done any like lab testing or other studies or anything that's a validation point, if you've won competitions and if you've won pitch competitions or, gotten any other awards, those are all things you can showcase and track and show the excitement that's forming around your company. Market timing and analysis, there is an element of luck, but the more you can, the more you can understand what's going on in the environment, the timing of both are you in a growing sector? Are you in a shrinking sector? What are other people turning away from to use your product, service, or technology? And, be able to anticipate what's going to happen within your business and then what other areas you either expand into or pivot towards or away from. So those are all the key attributes you'll be focused on figuring out for yourself and then pitching and making sure they're a key component of the pitch. You don't want to pitching too soon or targeting the wrong investors with no story, just slides, and being too technical. I think so. Too technical, unclear ask. It's not about the product; it's about the solution. So, the fact that like you could have a super technical, we'll take Uber. You could have a super technical presentation about all the features and functions behind the scenes and the architecture that makes Uber possible. But saying we found a way to leverage individuals around the world as drivers and get somebody from point A to point B within a 10-minute pickup wherever they are is a much more compelling story than going into all the technical aspects that even make that possible. So, the simpler you are, people can always ask questions later, and that's what you want. And then, making sure you're pitching to the right sector, you're pitching B2C companies to B2C investors and B2B companies to B2B investors, and you're pitching a pre-seed round to a pre-seed investor. All of that is essential. Pitching too soon, I would say you want the relationship to start early, but if you're not, you can frame it in a different way. If you're actively fundraising and now is the time and you're seeking this as we're raising this round, we have a firm closing date. This is an investor pitch we're inviting you to, then go with that route. If you want to build a relationship and this is something you're exploring over the next couple months, even ask for advice. Like say, I know you've gone into a lot of business in the space. We'd value your time to sit down, have a one-on-one conversation. And then we're not raising yet. Like be open about that. Say, we're not raising yet. We're considering a raise in a few months. We'd just like to get your feedback first and see if this is something you might consider in the future. And if you set the table that way, it opens up for more of those. It's like a saying, if you ask for advice, you'll get investment. If you ask for investment, you'll get advice. But it also sets the table of investors knowing this is where we were when we had that exploratory meeting. And then this is how much progress they were able to make in a month or 2 months since we've had that first conversation, and gives more of that baseline level set there. So it's never too early to relationship build, but you can pitch too soon to a specific investor.
Okay, thanks.
You want to get to know investor first. So looking at their portfolio, what they're proudest of, what makes them most excited. So see if they're a fit with you as well. So it can be really hard to reject an investor, but they're also going to be with your business for the long term. And you want to make sure somebody coming in has the same goals and visions. And if you want to build this, if you want to build your business for an IPO and they want to build this for a quick acquisition, they're probably not the best fit as an investor for you. And if you have multiple investors and one can add a lot more expertise, you're weighing that, and then another one has a better deal, you're weighing those decisions on what you value most at this stage and who you want to bring into the firm. And the more you can make this an opportunity versus an ask, and showing that this is something that's going to grow with or without them, and they have an opportunity to get in now and be a part of the action, the better the discussion and negotiations is going to be. I'll quickly go through this because these are 3 personas. The whole idea is not every investor is the same either. So especially if you're in a group like an angel group or VC that has multiple partners coming in, if you get to understand who the personality types are, churner is more of that methodical. They might ask less questions, but they're going to be sitting back thinking, analyzing everything, and then ask 1 or 2 questions that are going to be like, might try to throw you off guard or see how you respond to things. The charmer is going to be more of the enthusiastic, like people person out there. They might be super. So like if we look at both of these, the charmer might be the one that like gets really excited and says yes to a lot of things, but then narrows them down and only focuses on the ones to move forward with. The churner takes the other approach and is more, doesn't really commit or get too excited about things up front, but then they only, when they say yes, they mean yes, and they're going to move forward and really be excited to be a part of this. And then the challenger is always looking at like, what's the big opportunity here? How can we challenge the status quo, be disruptive in the market? They're going to be the investors that are the ones that like take the biggest risks and say, this company could fail or it could be $1 billion company, where some of these might have some, might be more of those risk takers. Others might be looking at like, is there a de-risk? The churner might be saying, well, this, doesn't have as high a potential, but they might be interested in something that's at least an acquisition and has a potential to be a huge business down the road and is a little bit more of a de-risked investment. So understanding the personality types, super important as well. Aligning to their thesis. The more we can make personal intros and even making cold introductions warmer. So that would be if you can leverage your connections, if you can, show up, and if they're a speaker at a panel, send them a LinkedIn message or go up to them and have a conversation at the event. It shows, you came out to see them, learn from them, and that can be a start of something really great there as well. Traction timeline. So the more you can predict, whether you have the traction today or you're predicting what your 90-day growth plan is and how, that's one model. Can go out even further. The more you can show, hey, this is what we're going to be doing. This is why our capital is going to help accelerate this growth, and basically paint that whole story of what the future metrics are you're going to be tracking. And then once they've invested, if you can hit those numbers, then they're going to come back with follow-on investment from there and want to be a part of future rounds as well. On the pitch itself, you want to start with one of these there's different ways to create the hook, but you can start with a surprising statistic, capturing the audience's attention right away, hit the problem solution gap fast with, how you're uniquely different and how you address a really big problem that's out there. Use emotion and data with compelling storytelling and create a compelling. We save families 40 hours a year and $900 a month using AI or whatever your solution is. Make it clearly understandable and, capture the attention to listen to all the details during the rest of the presentation. This is an example I wanted to share because I really like, this is back in 2013, so keep in mind like the delivery environment was a little bit different, but this is DoorDash's pitch at the Y Combinator demo day, and I'll just play, it's about 2 minutes, so just want to play their clip and then talk a little bit. Yeah, this will be kind of the last portion here, is we can talk about what you like or don't like from their pitch, and then get any final questions we can dive through and help out with on your own investment questions as well.
Hi, we're DoorDash, and we enable every restaurant to deliver. For customers, we offer restaurant food delivery in under 45 minutes. And for restaurant owners, we provide our own drivers, and we manage the logistics of delivery. Now, you might think that food delivery is a solved problem. But if you live in Menlo Park or Palo Alto, you know that's not true. Outside of pizza joints, just about no restaurant in this area delivers. Therefore, services like Seamless or Grubhub, which merely aggregate menus but don't actually deliver, don't work. In fact, that means the market is underserved because over 70% of the United States live in areas where restaurants don't deliver. Now, there are courier services who are sending people to place takeout orders on your behalf, but because they don't partner with the merchants, they are slower and structurally more expensive. We're the only company in this space that manages both our own logistics and partners with the merchants. We figured out the model to make consumer deliveries work. Because we control the entire experience of delivery, we offer the best performance at the same cost. When an order is made in our system, it gets placed immediately at an iPad installed at the restaurant. We've also built logistics software to make it dead simple for any driver to onboard into our network. Our logistics model is winning. In over 3,500 deliveries, we've averaged 44-minute delivery times between when you place your order and when you receive your food, better than our peers. But unlike our peers who operate in the cities, we did this in the suburb of Palo Alto, an area that's much more spread out and more difficult. Because of our great service, we've grown our weekly orders by over 30% week over week. And we've already generated over $1.5 million in annualized sales for our restaurants. We figured out how to make consumer deliveries work. Our growth, what's more, our driver network and logistics software enables us to even go beyond food. If you were building the FedEx of today to manage local deliveries, deliveries wouldn't happen overnight or even same day. They would happen on demand. And that's what we're building at DoorDash. If you're interested in hearing more, please come find us afterwards. Thank you.
Yeah, so I'd like to open it up. What stood out? Yeah, either share in the chat or feel on mic. Yeah, what stood out from that pitch to each of you? Does anybody want to share? Oh, immediately addressing the market. Great. Quick to talk about the potential, the difference between them and competitors. Yeah, so that's one of the things I really like too is they did the introduction. You understood what they were doing right away, and then he addressed the biggest question they were going to get asked. So he said, you might be thinking, yeah, the clarity, he said, you might be thinking this is already a crowded market. Why do we need another delivery app? And then he explained why you actually do need another delivery app and how they're different. So knowing, like, if you're in a lot of conversations and people always ask the same thing and there's not enough clarity around it, you can build that in and address that right up front. And, you're basically taking all the risk away and letting somebody then, be comforted and listen into Basically, if you don't do that, they're going to be thinking about that question during the rest of the presentation. So if you put it up front, they're, then they're thinking, okay, that's really interesting. How do they actually do this? And then, they hear all about it and want to learn more. So yeah, I know we're at the end here. I can stick on for a little bit extra. Basically, the market shifting, and yeah, with investor caution, data-driven decisions, founder focus, more and more traction, at more revenues become emphasized over, the user growth metrics of the past, but you're finding specific matches for, like, everybody has a different thesis is why there's so many investment groups out there. If everybody thought exactly the same way, there would only be one super large venture fund. So you want to find the right match for you, and then also recognize there's more investors that are putting money into things that can turn into revenue and profitability quicker than some of the models of growth at all costs from the past. And yeah, I'm happy to take any more questions as we wrap up here. So how is vibe coding changing the investor landscape? Yeah, it's interesting. I think there's like a lot of talk of going from 0 to 1 and then 1 to scaling from there, but I think what's gotten easier and then more difficult is going from 0 to the halfway mark of your product. Like, more the prototype has gotten a lot easier with all advances in AI technology and other coding platforms, low code, low code, no code platforms. Taking that from a prototype to a full-fledged startup is still an execution challenge. So yeah, there's a lot more competition at the prototype stage, especially trying to raise capital. And that's where, we have seen some of the focus move a little bit upstream. I'd say there's not as many ideas getting funding because, you can at least prototype something now with all the tools that are out there. But then again, the upside is, it's easier and cheaper to start something on your own and then have more proof points you can showcase to investors and get them excited and really stand out. Because, if you've built something where other people are just pitching an idea and you're able to show it in action, that's, even if it's vibe coding, that's still, showing you've done the initial work and can put your vision into action on paper and, share the whole story of where it's going to go from there. Yeah. Any other questions here I can address? And I'll send everything that's on the slide here. Oh, Artur. Yeah, and everything that's on the slide here, I'll send up in a recap email, and also share Nick's contact as well to connect with him on WeWork, or getting his personal advice as well. Artur, yeah, did you have a question? Oh, I don't think the audio is coming through.
Is it okay right now?
Oh, now I can.
Yeah. Hi, everyone. Thank you, Jason, for having us here. Yeah, I noticed in our chat that at least we have at least 3 descriptions that are more about using AI than the product itself. And my question is Well, from investors' perspective, is it not like they want to hear a lot about the AI? Is it not that now in this industry is using AI too much? Like, because I think like it's better to speak more about the product, what it gives you to your customers, than like speaking about like how you are delivering it. Just your opinion on this. And also just to mention that even nowadays I noticed that a lot of people, they are just like joking over this AI. For example, during the Oscar, they were just making a meme that our like Oscar is not AI based. And just your perception on this, what do you think?
Yeah, so I think what's going to change is there there's a lot of companies that are presenting as AI companies, but truly they should be presenting as ed tech or fintech or whatever their sector is. Like the best example I'd say is we used to hear a lot about cloud companies, and now it's just assumed most software that you're getting, or all software you're getting, is stored on the cloud, and it's a standard that you're a SaaS based, um, or either SaaS or freemium based model. So we used to hear, yeah, like when that came out, it was, oh, this is a novel cloud company, but now it's hey, this is a education platform, or this is a social media platform that runs on the cloud. So we're going to see the same thing in the AI space. It's going to be, this is first and foremost whatever category it delivers to the customers, and it happens to use AI in the back end to make everything more efficient, or to market more effectively, or whatever the use case is. It'll just be a function of it rather than like the business itself.
Thank you.
Yeah. Oh, and then the fact that people are, I mean, I think some of the jokes too also come with, people um, overusing. I mean, even this is an AI, followed some of the trends here with the AI doll creation thing, but um, I think, we had a period last year where everything everybody posted was AI generated, and we were losing some of the human elements. So I think where we're going now is let's train it or use your own voice and have it do something, but still get that personal touch from the authors or the people sharing these stories and messages, and use it to enhance what you're doing and get your message out there without replacing yourself with an AI.
I am myself, like personally, I'm afraid of using this AI because I think that the investors like get really like tired of this because everyone is AI, and I think it's just should you just this is my opinion. That's why I would like to hear yours. I think you should more speak about like what your product gives than like rather you use AI behind or not, because nowadays to use AI is just nothing. Like you just get the simple integration with ChatGPT like API, and that's it. You are done. It's AI.
Yeah, no, that's a great perspective. If you don't have, oh, I'll take Amy's questions too. If you don't, if you don't have revenue yet, how do you present to investors? So that's where the traction piece becomes more of a traction roadmap, and you can show these are the things. This is the timeline of you achieving certain goals, and where the investment comes in to help accelerate that timeline. And it's more of a, there might be things you've already checked off that aren't revenue. So, if that's establishing the team, establishing partnerships, prototyping the product, anything you've already done, you can check off on that roadmap. But the bigger aspect is going to be showing, hey, 6 months from now, or whatever the timeline, we're going to be transitioning from pre-revenue to pilot revenue to, our full-fledged product, and being able to show what that timeline looks like and why they want to get in at the pre-revenue stage, before, you know, the next round when you're a post-revenue company at a higher valuation. Perfect. Well, I appreciate all of you sticking on board here and asking great questions, interacting throughout. I'll share the recap video, the slides we went through, and then my email and Nick's email as well to answer any other questions. And then I'll share these resources too if you want to connect and be a part of everything we're doing from here. But yeah, appreciate all of you joining and thanks for participating.
Thank you, Jason.
Thank you.
Thank you.